Are we in the bubble? Hi, my name is Gary Mishuris. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So this is a pretty interesting environment. We've had a very long economic expansion. We also had a very long run in the equity markets. We have very low bond rates across the world for the most part. And people are asking, I think rightfully so, are we in a bubble? And I think that it's a question that cannot be definitively answered. And I think one insight I had recently after listening to Warren Buffett's Berkshire Hathaway annual meeting replay in audio format for the last 20 years is that even he, in the last two kind of big bubbles, the tech bubble of the late 90s and the housing bubble, he wasn't necessarily sure that we were in a bubble. Now, he saw danger signs. He saw asset prices for a number of assets that were too high in his estimation, and he passed in them rightfully. So he avoided the big losses. But it's very hard, I think, even no matter how good you are, for you to be able to say, oh, yeah, we're definitely in the bubble. I think it becomes clear after the fact if we were or if we weren't. But I think when you're in it, it's just too much to ask of yourself or anyone else to know that. Now, I think what we are in is a very dangerous investment climate. And why is that? So I think you have very low prospective returns embedded in a lot of assets, and conversely, you have very high asset prices. And you can point to a ton of examples. Oh, there are danger signs. Probably the most clear one to me is in the bond markets, where you have a huge portion of the bond market now at negative long-term rates. Uh, that is just completely irrational if one expects inflation to be positive, because think about what's happening here. Someone is giving $100 today to some government in Europe, and that says, yeah, I think inflation will be positive, so I'm very happy 10 years from now getting back $90, or in this case 90 euros. And by the way, that 90 euros will be able to buy only maybe 80 euros worth of stuff. Why would you do that? That makes no sense if you're following kind of long-term investment principles, because investing is inherently laying out money today in order to have greater purchasing power at a future time with a reasonable expectation and manageable risk. And this is not it. You also have many other kind of warning signs in the bond markets. You have very fairly low rates in the U.S. You have tight credit spreads. You have very permissive credit terms as banks and other lenders compete you for being able to lend. You have very questionable borrowers, the quote unquote high yield, except that they're not really high yield anymore. They're just bad credits, but they're being able to borrow at 5-6% for 6-7 years. Like, if you had a company come to you that had a ton of debt, more than they should, and the business wasn't doing particularly well, and they said, hey, how about this? Can you lend us money? We'll pay you 5% for the next 7 years, and if things work out okay, you get your money back plus the 5%. And if they don't work out, we'll file for bankruptcy and you get nothing, or very little. It doesn't sound like a good proposition to me, yet that's happening, right? So a lot of the signs are there. In the equity markets, what's happening is, the prices are fairly high, not across the board, but fairly widespread. And what's happening is that prospective returns are low. I mean, think about it. The market is up, as I say these words, roughly 25% year to date in 2019. Sure, we were down 5% last year, but no, now in and of itself, it doesn't mean anything, because obviously just because the market is up a certain amount doesn't mean that's good or bad. But this is on top of a very long streak of high returns. And also, there are plenty of other signs. You have money losing IPOs coming to market. You have, ton of investors operating who have not really fully invested through a serious recession themselves. So they've forgotten what it's like to really lose money. And they've read stories about prior crises or cycles, but they haven't really, had to be the decision maker, like myself, through those periods. So I think that the environment is very dangerous. And what I mean by that is very easy to lose money, and it's hard to make a good return. So I think that you guys should be very, very careful. And the more people are complacent and the more they're kind of partying and lending questionable companies money at low rates, the more they're, giving tons of money to money losing companies that are coming to the public markets for the first time. Just the more careful, conservative you should be with your approach, because once you have a big loss, if you lose 50, 60, 70% of your money, it's really hard to come back from that. Just the math is, if you're down 50%, you need to double your money, and doubling your money, you know, as an investment, not as a speculation, it's very hard, right? It takes a long time. So what can you do? I think that it depends on your circumstances, but whatever conservative means to you, you should do that. And by the way, that's not the same as conventional. There's plenty of conventional wisdom that's not conservative. It's just, what people do, and they don't do very well with that wisdom. So you should understand what conservative means in your circumstances, and you should set up your portfolio in a way that if the worst happens and we are in a bubble, and asset prices do decline precipitously for a period of time, that you're okay, that your portfolio can withstand that and can come out on the other side. That doesn't mean that you are gonna not have any mark-to-market losses in that year or something like that, but you don't want to have a giant permanent capital loss, or to have that scenario affect your life in a way that's unacceptable to you. So you should manage risk, and you should think about giving up a small portion of the upside in a way that allows you to mitigate a potential disaster. I've certainly spent a lot of time thinking about how to do that for my partnership, for Silvering Value Partners, and I've come up with an approach that I think is a good solution. It's not perfect, but it's the best I could figure out that meets those objectives. But you should definitely figure out what's right for you and implement that, because this is the time to be careful. I hope you found this video helpful, and if you have, please hit like and subscribe to my YouTube channel. Thank you.